Hi everyone, welcome to Topic 8. The topic of this week is evaluation of revenue management effectiveness. So let's go back to our core revenue management processes. Remember, core revenue management processes is a cycle, right? So we start with business analysis, we move on to pricing strategy based on the business analysis, then we do demand modeling and forecasting, and based on forecasted demand, we do price and inventory optimization, then we set booking controls and disseminate our pricing information to various distribution channels. Now we are closing the loop this week with these topics, which is the evaluation of revenue management effectiveness. So in this context, let's look at the topic of the week, learning objectives. Analyze the depth of key performance indicators for revenue management and apply performance metrics to create and measure the effectiveness of a strategy. So, the most basic and most important revenue management performance measure happens through Smith Travel Research and benchmarking. So let's briefly reintroduce this and then remember what it is about. Right, we have three key metrics that we do benchmarking, and remember, benchmarking is only for the hotel rooms, okay? It doesn't include other revenue generating centers in the hotel. So market penetration index is for occupancy, average rate index is for average daily rate, then revenue generation index, RGI, is for RevPAR. So our occupancy is how full our rooms are, right, in relation to our room capacity. Average daily rate is, total rooms revenue divided by number of rooms sold. And RevPAR, revenue per available room, is a combination of occupancy and ADR, right? When we multiply hotels occupancy with hotels average daily rate, we get RevPAR. So these are our three key statistics, right? And this benchmarking service is provided by Smith Travel Research, and we have discussed this topic in competition and competitive set analysis. So, a hotel needs to identify a minimum of 4 competitors, right? That they think are their direct competitors. Then Smith Travel Research will look at its own data set to make sure that they have data from these hotels, right? Representation is very important, but anyway, subject hotel will identify a minimum of 4 hotels, can be more. On average, ComSet size is about 4 to 6 with Smith Travel Research benchmarking service. So then once subject hotel knows that their competitors submit their data to STR, then at the end of each month, hotel is going to receive a report where their occupancy is compared to ComSet occupancy, their average daily rate is compared to ComSet average daily rate, and their RevPAR is compared to average ComSet RevPAR. Right, and the base value of this index is 100. If the index values are above 100, that means on a percentage basis, a subject hotel is doing better than the ComSet. If the values are below 100, that means subject hotel is doing worse as a percentage on a percentage basis in comparison to the ComSet. And if the index value is the base value, which is 100, that means subjects occupancy, ADR or RevPAR equal to the competitors occupancy, ADR or RevPAR. So this is the summary of Smith Travel Research benchmarking service. And when we covered this topic, we talked about some of the downsides of STR. First of all is the representation, right? If subject hotel prepares the ComSet and if the competitors do not subscribe to Smith Travel Research, then this is not exactly going to work, right? And especially if you are boutique type of hotel, regional type of hotel, you know, you don't have international presence, maybe you are not going to have the financial means to subscribe to STR benchmarking report, right? If you cannot subscribe, you cannot do benchmarking. And when we look at the representation of Smith Travel Research benchmarking data worldwide, we see that it is mostly international hotel management companies that subscribe to STR services. So that is the snapshot of what STR is about. So if we ask this question, is benchmarking enough to measure revenue management performance? So the answer is, it is not enough, but it is all we have, right, in terms of comparing ourselves to the comp set. So MPI, ARI, and RGI are the only three measures where a hotel can compare its performance to the competitor set. Okay, in a little bit, I'm going to introduce you with other measures, other performance measures in revenue management context, but they are mostly for the hotel only. So you can have a target performance metric, but you are not able to compare it with your competitors. Okay, so that is sort of the weakness of those measures. So here is again the computation of benchmarking variables. So all three are computed the same way. If we take the example of occupancy, it is your occupancy divided by ComSet occupancy. So here the caveat is that the hotel needs to make a decision whether to include themselves in the competitor set occupancy calculation or not. Right, so this is a choice given to the hotels. Some hotels choose to include themselves and some hotels don't. But there's no right or wrong answer. So if you include your own data in ComSet occupancy calculation, then you can see your fair share, right? Because you are a part of that competitor set basically. But if you decide not to include yourself, this is also okay, because maybe you want to see the performance of the ComSet separate from you. Okay, so these are the choices given to the hotel. And this is the interpretation of the indexes. So this is what I have already explained you, and this is repetition from our competition and competitive set analysis chapter. So then let's come back to the big topic, big question here. How should a hotel select its key performance indicators, right? So if you're a hotel that is seriously implementing revenue management, you will definitely do STR benchmarking. So you are going to get this monthly report where your performance is compared by ComSet performance in occupancy, average daily rate, then RevPAR. Okay, if this is in the pocket. So now on top of this, what should be your revenue management KPIs? So this totally depends on revenue management objective of the hotel. Okay, there are several choices here. Hotel might opt for doing revenue management for the rooms department only. Okay, or they might do total revenue management. That means they are going to implement revenue management in all revenue generating departments, right? Or they might select to do it in some departments only. Maybe they do it for rooms department and function space. Maybe they do it rooms department, function space, and food and beverage, right? So hotel need to set themselves a revenue management objective. Or they might be targeting profitability, right? Maybe their revenue management objective is not revenues at all. Maybe they are targeting profits, right? Or they might be targeting customer loyalty, right? They might be targeting many things, and we are going to see these in the examples that I am going to show you shortly. So once again, the selection of key performance indicators depends on revenue management objective of the hotel. And here, when we talk about key performance indicators, we are not talking about at the hotel management level, okay? We are discussing everything at the revenue management strategy level. So how about some other KPIs? Okay, what are they? So, and again, these are mostly related to revenue management. Some are related to marketing and sales because, these two fields are becoming closer and closer together. Average length of stay, right? This is actually quite important, when a customer checks into the hotel, how long they stay at the hotel. Um, I'm thinking, for example, a major metropolitan city average length of stay is going to be different than a resort destination, right? It's going to be different according to the hotel type. And destination and type of target customers. So average length of stay during different seasons, this is something definitely hotels should examine, right? And if the average length of stay is too short, for example, what can hotels do to increase this? Right, so average length of stay for different customer segments can potentially be a KPI. Market share. So market share is very much attached to occupancy, right? When you look at your occupancy index, you should be able to see your market share as well. And if there are certain segments where you are not able to get your fair share, then you need to investigate why, right? And see why you cannot get as much business as your comp sets, and what can you do to get there. So market share is definitely an essential KPI to look at. Then we have guest satisfaction index. Quite early in this term, I have introduced you revenue management circle, and in cycle, sorry, not circle, revenue management cycle. In revenue management cycle, we said that hotel revenue management price the room, sales and marketing sell the room, and then our operations staff creates guest satisfaction, and all these have to work together for revenue management strategy to work. Okay, so certainly guest satisfaction index can be a KPI. Okay, given that all revenue management strategy that is being implemented between revenue department and sales and marketing department will not work if the guests are not satisfied, right? So this is definitely a relevant measure to look at. Then we have all these, additional revenue management measures, right? First we start with total revenue per available room, occupied room, available square feet or square meter. So these measures are suitable for hotels that try to implement total revenue management, right? So your focus is not only rooms revenue, you are looking at other revenue generating departments, including again your function space, your food and beverage, your spa, your rental space, etc., 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 whatever space you have that you sell within your property. And there are some nuances, right? Like differences. For example, available room versus occupied room. They show you different statistics, or revenue per available square feet or square meter. So in this measure, you are looking at all the potential space you can sell in your hotel, right? Another upcoming measure that we see is net revenue per available room. In net revenue, you get rid of the commission that you pay, commission or any kind of cost that you have associated to selling that room. Okay, so gross room rate minus the commission and the cost to sell that room equals net revenue per available room. Then we have RevPAC. RevPAC is the revenue per available customer. So this should be total revenue as well, not only room revenue. Total revenue per available customer. Here you want to figure out, right, who are your valuable customers. So you might have a customer that is very price sensitive for the rooms, but maybe they spend a lot of additional money, right? So again, if you're a hotel that is focusing towards total revenue management, then revenue per available customer is definitely a relevant statistics that you should take a look at. And then when we move from a revenue point of view to a profit point of view, the measures we would consider are GOP PAR and GOP POR. So When we say the focus of revenue management is changing from a revenue-driven approach to a profit-driven approach, the type of profit we talk about here is the gross operating profit, okay? We are not talking about net income or net profit. You know, think about your income statement. You start with revenues and you get rid of some variable expenses and you reach GOP, right? After GOP, you have, I think, undistributed cost, you have to pay taxes, etc. to reach your net income. So I'm not at that level. I'm talking about the top line variable expenses that you deduct from total revenue to reach gross operating profits. Okay, so if a hotel is sort of, you know, looking at a more profit-driven revenue management approach in comparison to a revenue-driven approach, then they would have gross operating profit per available room and gross operating profit per occupied room as their revenue management measures. And then let's look at some more specific revenue and then marketing and sales specific measures. Demand forecast accuracy. So we had this chapter talking about demand forecasting and availability, right? And we had a case for this. Should forecast accuracy be a key performance indicator or not? And we had one of the Duetto founders, Marco Benvenuto, talk 5-6 minutes about this, and I agree with him fully. In my mind, forecast accuracy should not be a KPI, but still in many international hotel brands, including the ones like Hilton, they have I think it's around 3%. 3% is the expected demand forecast accuracy, and 3 to 4% seems acceptable as well. But if your forecast error is higher than 5%, then you are penalized for that, right? I personally don't think that this is the right approach. Then we have booking window. Booking window is just like booking pace, okay? You are basically looking at how far in advance your customers are booking their stays, right? And we don't look at this at the aggregate level. We don't look at this generally to all our customers, right? We look at this per customer segment. And also we see today people, especially with short haul destinations, people have a much shorter booking window, right? And does a shorter booking window indicate effective pricing and revenue optimization? Not always, but what you need to do is to study the booking window, right? Booking window for certain customer segments, and how are these booking windows changing over time for the same customer segment, okay? This is what you should be looking at. And if you see this behavior changing, let's say the booking window is becoming shorter, then you study what does that mean for that customer segment, and then how does that translate into your pricing strategy, right? Should this be a KPI? I'm not sure. You should definitely analyze this on an ongoing basis, right? This should be part of your ongoing business analysis. Should that be a KPI? Maybe not necessary. Then another prospective KPI is channel mix. So review the distribution of bookings across different channels, direct bookings, various OTAs that you work with, travel agents, etc. Right? So this is also definitely part of ongoing business analysis, right? You have to study your channel mix. You have to understand where the majority of your business is coming from, which particular OTAs, right? And you study the associated commission and see whether you can direct some of those bookings to your direct channel, etc. And we saw in the strategic pricing and management of distribution channels chapter that a favorable channel mix can signify effective distribution strategies. So other two, these are related to marketing, but important measures: customer acquisition cost and customer cost of acquisition versus lifetime value. So customer acquisition cost refers to cost of acquiring each new customer considering market expenses and commissions paid to third-party booking channels. So getting a new customer is important, right? But customer acquisition costs are increasing, and this also shows the importance of your loyal customers, right? Loyalty is also something that is disappearing at a fast pace today. But it is important to study customer acquisition cost and try to look for ways to reduce this cost. So I think this should definitely be a KPI for marketing. Should it be for revenue management? It depends on how integrated revenue management and sales and marketing is. And the last point here is cost of acquisition versus lifetime value. So this one compares the cost of acquiring new customer with their lifetime value to ensure long-term profitability. Again, when we talk about lifetime value, to be able to calculate lifetime value of the customer, you need to have historical customer data, right? You need to know how many times this customer stayed at your hotel, how they spend their money across different departments that you have in your hotel. You should be able to collect all that information along with the cost of acquisition so that you can calculate the lifetime value of the customer and compare that with the cost of acquisition. Should this be a KPI of revenue management? It is definitely a very important metric to look at, but maybe not for revenue management, right? This is more for marketing purposes. Now, I would like to share with you findings of a 2018 study on hotel revenue management. HSMI, Hospitality Sales and Marketing Association International, has commissioned Singapore Institute of Technology to undertake a research on revenue management. So in this study, the purpose is to identify different revenue management metrics in use, their limitations, and possible new revenue management metrics. So this study targeted global individuals at the managerial level at the hospitality business sector, and top 3 functions of the respondents are revenue management, 78%, marketing and sales 9%, and operations 5.6%. So I can tell you that we can rely the findings of this study because majority of the respondents are in revenue management. So this report is quite long, so I have it as a reading recommendation to you, but I would like to highlight some of the findings. So here, the question is on revenue management culture in general, right? And the options are rooms only, rooms plus catering with integrated marketing, and total revenue optimization with integrated marketing. So here the most basic answer would be rooms only, right? So they are like 34% of the total respondents said that they are doing rooms only revenue management. And this is, 2018 is right before the COVID, right? Right after the COVID, these things have not changed and have not improved at this point. Then we have rooms plus catering. So this is the next category. So catering, this is going to include food and beverage operations, right? So about 15% of the respondents said they are doing rooms and F&B revenue management together. Then the next evolved category is rooms and catering with integrated marketing. So something happened as a result of COVID is that we don't look at silos, departments standalone anymore, okay? The departments are becoming close to each other in terms of their functions, and one of these departments is sales and marketing and revenue management, right? They are becoming closer to each other, and we start seeing this trend even prior to COVID with this example, right? So about 8% of the respondents were doing revenue management, rooms and F&B with integrated marketing functions. And good news, about 42% of the respondents mentioned that they were doing total revenue optimization with integrated marketing. So it is quite a big chunk, 42% of the respondents. Then the respondents were asked about their perceived limitations of revenue management measures. And the primary limitation by 53.2% is lack comprehensiveness. So what does this mean? So revenue management measures usually do not include cost, profit, or different sources of revenues. So this is perceived as the biggest limitation. Next is with 20.7% data accuracy. So some respondents were not sure about the authenticity of the information provided by the hoteliers, but there were more respondents that were concerned about the ability of vendors to include all hotels and other type of accommodation property, such as Airbnbs or vacation clubs, so that they can use the relevant COMSET for benchmarking purposes. Okay, and other data accuracy problems include different reporting practices, timeliness of information, and inventory variation. So the third one is not comparable with 10.1%. So this one is related to measures such as total revenue per available room or gross operating profit per available room not being included in benchmarking reports such as Smith Travel Research reports, right? And as a result of this, hotels are not able to make meaningful comparisons against their competitors. This is also a limitation that I have highlighted, right? Except for STR benchmarking measures, which are MPI, ARI, and RGI. Any other measure you have, you are not able to compare it with your COMSET. And that then represents a major limitation. And the last category is organization constraint with 5.5%. So this one is related to some measures being complex and basically you do not have in the organization enough people that are knowledgeable and experienced decision makers. So next, let's take a look at willingness to adopt new revenue management metrics. So before the data collection in survey method, the authors also did a focus group type of discussion with the respondents, and from that discussion 2 measures came out as upcoming important revenue management measures in this study. Those are net revenue per available room and revenue per available customer. So these are the statistics that we actually already define as possible KPIs in the first section of this lecture. So now let's look at positive and negative factors affecting adoption intention. So they are, working in both ways, right? So in this research, something can be a negative factor or something can be a positive factor. And obviously, we have perceived usefulness is the highest positive factor. Industry practice, we have also some positivity there, and with a little positivity in organizational constraint. Other than that, organizational constraint, data accuracy and availability, perceived usefulness, and effort, they are all considered as negative factors. So now let me look at the study findings to tell you what these mean. So perceived usefulness is the most significant factor. So these new metrics are regarded as valuable to drive channel optimization and total revenue management, increase efficiency and return on marketing efforts, improve planning and budgeting. Essentially, these advantages enable the hoteliers to develop effective strategies. It is also important to note that usefulness of the measures is greatly associated with data accuracy. To some lesser importance, support from company top management and the need to be in line with the industry practice are 2 other motivation factors. So these are the positive motivation factors. Let's take a look at the negative factors. So Text analysis on respondents' comments show negative adoption intention can be attributed to 4 factors. Okay, first is the perceived lack of usefulness. Okay, and this is related to current measures. Basically, with the current measures, they are happy, so they don't see the need to adopt new ones. And others do not think that the new measures provide relevant or additional benefits and insights. Maybe they are not applicable to their properties. Second, respondents generally commented that they are not the decision maker. The adoption needed top management to buy in the idea. Okay, so if top management doesn't agree, basically they cannot implement the measure anyway. And in addition, there should be knowledgeable personnel and appropriate technology in place to implement the performance measures successfully. So in short, organizational constraint is an important factor deterring the adoption intention. And the third factor is related to the effort required to implement various revenue management metrics. So respondents cited that the time and effort needed to implement the contemporary measures is substantial, right? And they are already overwhelmed with the existing revenue management metrics, and they don't have the interest or motivation to add additional ones. And data accuracy and availability is the fourth negative factor here. And respondents commented that the relevant measures are not included in suppliers and vendors report like Smith Travel Research, right? So they cannot do benchmarking. Also, respondents distrust the data provided by the hoteliers, okay? Especially when the reporting practices vary among the different companies. And lastly, in this report, we are going to take a look at perceived problems associated with the new measures. So here we have two largest set of answers, again related to organizational constraints and data accuracy and availability, followed by trade-off and adoption rate. So let's see what these refer to. The first one is the organizational constraints. So according to the respondents, many of the current systems are either insufficient to accommodate or incapable to incorporate the data needed for the new metrics. Furthermore, as the knowledge on this respect is generally limited, proper staff training and education on the new measures are needed. So the next category is data accuracy and availability. So this has been consistently a concern for both current and the new measures proposed. The absence of a standard reporting format has been repeatedly cited by the respondents. Data accuracy is further impeded by the difficulty to correctly distribute the cost involved and revenue generated within the hotel operations. The third category is trade-off. So trade-off is about the trade-off between the time and effort invested and additional benefits gained. Not only are the data needed for accurate measurements is, complex, but substantial amount also curtails the ability of manager to process information efficiently. So maybe this is where artificial intelligence and machine learning can be of help, right? So when some of these, manual time-taking tasks are handled by AI, maybe revenue team will be more willing to use these new revenue management measures. And the last category is the adoption rate. So respondents here question the adoption rate by the industry practitioners, okay? Because hotel industry is known to be generally, very slow in adopting changes. So the implementation of the new metrics will further be restricted without the initiative from the vendors. So now let's take a look at the overall limiting factors. So where are we standing again? Industry is happy with using Smith Travel Research benchmarking reports because they are happy to see compared performance, right, in occupancy, ADR, and RevPAR. But when it comes to implementing new measures, they are very skeptical. They are maybe willing to implement two, net revenue per available room and revenue per available customer. But other than that, we talked about many possible KPIs. They are a little bit reluctant to use those, okay? And it is mainly one of these 4 issues. First one is the data accuracy. It's about authenticity of the data, reporting practices across different hotels, right? But maybe they are not using the same way to record information, so how can you rely that kind of data? Timeliness of the data and inclusive of various types of property. Comparability, again, if it is not part of STR data, you cannot compare it, right? So, and if you cannot compare it, is it worth it to have that measure as a KPI? This is what the respondents were asking to themselves in this study. Also, organizational constraints. So not many people truly understand revenue management, right? So not everybody can delve into these additional KPIs, compute them, and make sense out of them. And also, you need to have top management support. So this is not just, revenue management can do within themselves, right? You need to have commitment from executive management of the hotel to support this new revenue management strategy and new KPIs to support that decision-making process. And of course, the technology, the right technology itself should be there to ensure data accuracy and data availability. And finally, there is substantial time, time and effort involved in collating and analyzing the data. And again, here is where AI and machine learning can help hotels to do some, basic sort of data collection and analysis.